Build your dreams, live rich, and leave rich.
Welcome to Live Rich and Leave Rich by Krish. Today, we are going to tackle a really powerful but, often misunderstood investment idea, the fund of funds. It's a concept that can completely change and simplify the way you invest. And I promise, by the end of this deep dive, you'll get exactly how it works, inside and out. The whole point of smart investing, the core philosophy here, isn't really about living some crazy, lavish lifestyle. It's about getting to a place of financial peace and understanding the right tools to get you there. Well, that's the most critical first step you can take. All right, and of course, a quick but very important note before we jump in. Everything we discuss today is purely for your education. It's so important that you please consult a SEBI-registered financial advisor before you go ahead and make any investment decisions. Okay, let's get right into the heart of it. There's this myth out there that to build a truly world-class global portfolio, it has to be incredibly complicated, right? That you need to become a part-time analyst, tracking dozens of different funds, spending your weekends buried in spreadsheets. And for most normal families, this just feels like an impossible task. It's overwhelming. But I'm here to tell you that myth, it just isn't true. Give me the next few minutes, and I'm going to introduce you to something I call the manager of managers. It's a way for you to own the very best funds on Dalal Street and even the global giants like Apple and Google, all with a single peaceful click using Indian rupees right from your Indian bank account. So to really understand this powerful concept, we don't need any complex financial jargon, not at all. Instead, we're going to use a simple story, an analogy that I think everyone in an Indian family can immediately relate to. Let's call it the master wedding planner analogy. Just imagine for a moment that you're planning a big, beautiful, grand wedding for your family. Now, you've really got two choices. The first choice is the do-it-yourself route. You could spend weeks, maybe even months, researching, interviewing, negotiating with dozens and dozens of different vendors. You have to find the best caterer, the best decorator, the best photographer. It is a huge amount of work and stress. Or there's another way. You could just hire one person, a master wedding planner. Now, this planner, they don't cook the food themselves, they don't arrange the flowers or take the photos. Their one and only job is to use their expertise and your budget to go out and hire the absolute best specialists in the city, all on your behalf. You see? You hire one expert and they manage all the other experts for you. And what's so amazing is that a fund of funds, or an FOF as it's called, works exactly like that master wedding planner. It's a very special type of mutual fund. But here's the key difference. Instead of its manager buying stocks directly, like a share of Tata Motors or Reliance, the manager's job is to research and invest your money in other mutual funds. You invest in just one fund, and its manager builds you a whole portfolio of several other expert funds. It's literally a fund that buys other funds. So, that's the big idea. But how does this actually work in practice? Where does your money go? Let's follow the money step by step. We're going to trace the journey of a simple investment just to see the real magic of this structure. Let's make this real. Imagine you decide to start a systematic investment plan, an SIP, of just 5,000 rupees a month into a fund of funds. You set it up on your app. That first 5,000 rupees is debited from your bank account. Now, what happens? Where does it go? Okay, so the manager of your fund of funds now has your 5,000 rupees. Their job isn't to look at the stock market. Nope. Their job is to look at the mutual fund market. They spend all their time analyzing and choosing the best funds out there to act as the specialist for your portfolio. So, going back to our wedding story, these are the expert caterers, the expert decorators, the expert photographers. In the financial world, we have a name for them. We call them the underlying funds. And this is where the power of this idea really shines. The FOFO manager, your master planner, takes your $5,000 and instantly allocates it across their hand-picked team of experts. For example, they might put $1,000 into a top large-cap fund that owns India's 100 biggest companies. Another 1,000 might go to a great mid-cap fund focused on faster-growing businesses. Then maybe 1,000 into a banking sector fund, another 1,000 into an infrastructure fund, and maybe the final $1,000 goes into a stable bond fund. So think about what just happened. With your single $5,000 investment, with one click, you have instantly become a part owner of hundreds, maybe thousands of different stocks and bonds across completely different strategies, all managed by a team of specialists. That is incredible, automatic, instant diversification. Okay, so that is really powerful for investing right here in India. But where the fund of funds concept truly becomes a game changer, especially for Indian families, is when we start to look beyond our borders.
This is where it acts like your own personal, completely hassle-free global passport for investing.
Let's say you or your kids want to own a piece of amazing global companies like Apple or Google or Amazon. Well, the hard way to do this is honestly a nightmare. You'd have to figure out how to open a US brokerage account, deal with all the complex RBI paperwork to send money abroad, convert your precious rubies into dollars, and lose money on the conversion fees both ways. It's complicated. Now, compare that to the easy way. An international fund of funds. You just open your regular Indian investment app, find a fund that invests in, say, US technology, and you invest your 5,000 rupees. In rupees. That's it. You're done. Behind the scenes, the Indian FOF manager does all the heavy lifting. They handle the compliance, they convert the big pool of money, they deal with all the complexity, and they simply invest it in an underlying fund in the US that holds all those giant companies. You get to own the world's best companies seamlessly without ever leaving India. All right, so far this probably sounds almost too good to be true, doesn't it? One-click diversification, a passport to global markets. I mean, it's the ultimate convenience. But in the world of finance, convenience always has a price. So let's ask the most important question of all, what's the catch? This is the reality check. That professional management, that incredible simplicity, it's a fantastic service. And just like any service you pay for, it comes with a fee. It's so crucial that we understand exactly how we're paying for it because, well, it's not quite as straightforward as a regular mutual fund. Okay, first let's do a quick refresher. Every single mutual fund charges an annual fee. It's called the expense ratio. The easiest way to think of it is as the salary that you pay the fund manager and their team for researching and managing your money all year. It's a small percentage of your investment and it's deducted automatically.
And now, here is the catch with a fund of funds. You are actually paying 2 layers of fees. Let's go right back to our wedding analogy. The expert caterer who cooks the food, they charge a fee for their service. And the master wedding planner who found that great caterer for you, they also charge a fee for their expertise. It's exactly the same here. Each of those underlying funds, the specialists, has its own expense ratio. And on top of that, the main fund of funds manager, our master planner, also charges an expense ratio for their work of selecting and monitoring those funds. This is often called the double expense ratio. You are paying for convenience, and it is absolutely vital that you check the total cost to make sure it's worth it for you.
Okay, we've covered the structure, we've covered the cost. Now for the final, critical piece of the puzzle that every Indian investor absolutely must understand before buying an FOF, and that's the tax man. How does the government view the profits you make? This is not a small detail, it's critically important. See, if you invest in a regular equity fund that buys Indian stocks directly, and you hold it for more than a year, your profits are generally taxed as long-term capital gains. But a fund of funds is treated differently. Because it technically holds units of other funds, not stocks directly, the taxman often treats it like a debt fund for tax purposes. This typically means that any profits you make are simply added to your annual income, and you pay tax according to your personal income tax slab. So just think about that. For someone in the 30% tax bracket, this means your profits could be taxed at a full 30%, which is significantly higher than the tax on a regular equity fund. It's a crucial trade-off. You get incredible simplicity and diversification, but potentially at the cost of higher taxes. You must be aware of this and factor it into your decision.
Phew, we have covered a lot of ground today. So, just to make sure all of this really sticks, let's quickly recap the key new terms we've learned. Think of this as your new simplified financial dictionary. No jargon, I promise. First up, the big one we've been talking about, a fund of funds. In one simple sentence, it's a single mutual fund that invests your money into a hand-picked team of other expert mutual funds.
Next up, what about those funds it actually buys? That's an underlying fund. This is simply one of the expert individual mutual funds that your master manager selects and invests in on your behalf. And finally, the cost. The double expense ratio. This is just the total fee you pay, which includes the fee for the main master manager and the fees for all the individual funds that they chose for you. So after all that, is a fund of funds right for you? Well, it can be an incredibly powerful tool for simplifying your investments and for getting that global exposure peacefully. But like any tool, you have to understand its costs and its rules before you start using it. To learn more about how to use smart tools just like this one to build a lasting financial legacy for your family, I invite you to check out the Legacy Diary. Thank you so much for your time.